Want to leverage up your IRA and buy real estate? This is how you can do it. One of the main advantages of using a self-directed IRA to make investments is you get to invest in assets you know and trust, you get to diversify your retirement portfolio, and you get to also buy hard assets. That's why real estate is one of the most popular investment options for self-directed investors. Well, guess what? We all know real estate investors love to use leverage. Who does it? Who doesn't want to use other people's money to invest? Well, here's a couple things you need to understand if you want to use leverage to buy real estate in a self-directed IRA. Number one, the loan must be non-recourse. A non-recourse loan is a loan you do not personally guarantee. Why? Because the tax code under Internal Revenue Code section 4975 does not allow you to personally guarantee an obligation of your retirement account. Therefore, the loan must be non-recourse. Okay. Number two, if you are using leverage, you may want to consider a 401k. If you're self-employed or have a business with no full-time employees other than the owners or their spouses, you can potentially set up a solo 401k and use a non-recourse loan to buy real estate and pay no tax on the use of the leverage. There's an exception under 514C9 of the Internal Revenue Code that allows a 401k to buy real estate through a non-recourse loan, super leverage that asset up, and pay no tax on it. And that tax, that four-letter word tax, is known as UBTI or UBIT. And it's a tax imposed on an IRA that uses leverage to buy real estate. So you got two options. If you're going to use leverage to buy real estate, it's got to be non-recourse. If you're using a self-directed IRA, you're going to have to think about the application of the UBTI tax. If you're using or potentially can use a 401k, you'll be able to super leverage up your asset and pay no UBTI tax. Now, how does the UBTI tax work? Well, here's a simple example. If you have $50,000 in your IRA and you borrow $50,000 on a non-recourse basis, you have a 50-50 debt to equity ratio. Let's say the investment generates $10,000 of net income after deductions, depreciation, expenses. Then 50% of that $10,000, which equates to the debt portion of the investment, would be subject to this UBTI tax, which can travel as high as 37%. Whereas if you use a 401k or a solo 401k, there would be zero tax on using leverage. So you can see the advantage of using a 401k, getting around the UBTI tax, and taking advantage of the opportunity to leverage up your self-directed retirement account and buy real estate with no tax.